Hi, my name's Eddie Donmez and I have the pleasure to be sat down with Ryan from Invesco. Ryan, can you tell me a little bit more about yourself?
Sure. So my title is a senior factor and core equity strategist, which is a mouthful, and really just a fancy way of saying I cover about 100 equity funds in the US. Recently, in the past, call it 2 years, we've seen a lot more international demand for US-based strategies. So I've been thankful and I've had the opportunity to travel around the world to kind of talk about some of the indexes that our funds are based on, and markets in general.
And for the audience, could you give a brief kind of overview of Invesco? What kind of things you do, what kind of products you offer?
Sure. So on the Invesco ETF side of things, I think our offering in the US is over 220 funds. You know, what's interesting is there's a handful that are probably most well known, one of which is the 5th largest ETF in the world. But generally, I think Invesco equity ETFs are more well known for kind of the smart beta, the alternatively weighted strategies, single factor, multi-factor. That's really where the bulk in terms of the number of products on the equity side. And then we have pretty robust fixed income offerings. We have a commodity sleeve, alternatives, thematics. So, you know, pretty much we're pretty wide ranging when it comes to the type of exposure that we can provide.
Brilliant. And we're going to be discussing the Nasdaq today, but for the audience that may not be familiar, what is it?
The Nasdaq-100 has really blossomed into this like preeminent large cap growth index in the US and widely used both in the US and globally. Quite simply, it's the 100 largest stocks listed on the Nasdaq exchange ex financials. And everybody always asks, well, why are there no financials? Back in 1985, when the index was launched, on the same day, Nasdaq launched the Nasdaq Financials Index, which from what I'm told, at the time, it was the one believed to have more like commercial viability, a little bit more demand. And so we joke that this is one of those cases where it's like better to be lucky than good, because the only time I ever talk about that index is right now, like when I'm making this comparison. And the Nasdaq-100 has, you know, hundreds of billions of dollars that track it via futures, via ETFs, via funds. So it's really kind of fit in the large cap growth segment of the market because of the types of companies that have listed on the Nasdaq exchange.
What are the different weightings towards different sectors like consumer communications and consumer discretionary?
Sure. So I think it kind of depends on the classification that you look at, right? I mean, I think traditionally a lot of folks use the GICS classification, which is the Global Industry Classification Service. That's generally when you're looking at something like an S&P sector. From there, it's about 50% technology, right? Kind of depends on the day that you look. Then you look down to consumer discretionary, generally in the high teens, communication services in the teens, again, sort of depending on the day that you look. Nasdaq uses the industry classification benchmark, or ICB. And when you look at ICB, the technology weighting balloons up to around 60%. But then reasonable weightings in consumer as well. But you know, it's that misnomer that it's just a technology sector. I think it really is. You know, it's getting harder and harder to put companies in like a designated technology box. Right? If a company hasn't sort of adopted the use of technology by now, it probably is a pretty bleak outlook for them. And you know, I think with that, you look at companies like, let's say, an Amazon, right? Amazon per GICS, or Global Industry Classification Service, that's designated as a consumer discretionary stock. And I get it, right? They've got a huge presence in the retail arena, but they're also kind of the world's preeminent provider of cloud-based solutions. A company like Tesla, also a consumer discretionary stock because it sells EVs. But you know, you look at their infotainment system and you know their aspirations to be maybe a technology company. I mean, Elon Musk has been pretty vocal about that. You know, could you see them becoming more kind of technologically oriented? Sure. I mean, even their battery technology. Is there an avenue at some point in the future that they look more like a utility company? I mean, I don't know what the future holds, but possibility exists. So I think you just look at what's transpired over the past 20 years, how a lot of these companies have diversified their business lines. I think it's just harder to say, oh, you're just a tech company.
Every company is a tech company.
Yeah, exactly, to some extent.
So there's a few different ways to actually invest in the Nasdaq. Could you run through some of the different ETFs that you provide and how investors can think about those different ways to get exposure?
I think when you look at the success of the Nasdaq 100, right? I mean, it's I was saying before, so widely used, so widely tracked. It sort of spurned kind of offshoots, right? Or it sort of broadened the ecosystem or ways that you can get access. So we have a number of strategies that track the Nasdaq 100 as it is, right? Just plain and simple. From there, we've kind of worked with Nasdaq and developed strategies that track the Nasdaq 100 ESG index, the Nasdaq 100 equal weight index, and then even new indexes that have been born out of the Nasdaq 100 success. I mean, one would be the Nasdaq Next Generation Index, which takes sort of a more mid-cap view of some of these Nasdaq listed companies. I think what's interesting is just you've seen the growth of not only the parent index, so to speak, the Nasdaq 100, but you're starting to see offshoots and different ways that investors can access kind of the Nasdaq 100 depending on what they're looking for.
I think most people probably are very familiar with the Nasdaq 100. What's the difference between a market cap weighted index and an equal weighted, and what are the implications for an investor looking at these different options?
Sure. So, Nasdaq 100 index is a modified market cap weighted index, which essentially means that the largest companies get the largest weightings in the index. An equal weight index is it's an example of a smart beta index, right? Where you're using, or an alternatively weighted, you're using a metric other than market cap to reweight an index. And I love equal weight because it's like the easiest one to explain, right? You take every company in the Nasdaq 100 and you give it an equal weight. From an implication standpoint, it's going to look and feel a little bit different. Even though you're holding the same names, the weighting scheme does change the experience. For starters, you're going to be picking up a little bit more on the small size spectrum, right? So, the number 97, 98, and 99 holding in the Nasdaq 100 is going to have the same weighting as Apple, Microsoft, and Amazon, let's say. So it's going to look a little bit different on that front. I think we've seen investors utilize equal weight strategies to help mitigate a little bit of concentration risk that they may have on the portfolio. I mean, you can turn on any major financial news network and, it's not going to take long before somebody says, oh, we look at the top of this index and it's looking rather concentrated. Equal weight strategies provide a pretty easy way to naturally diversify away from that.
Absolutely. I think that concentration risk is key, and it can be a blessing or a curse for many investors. Contrary to maybe many forecasts over definitely this year and into last year, that concentration risk with the likes of Nvidia and Apple and Microsoft, AI wave has obviously powered that index. So what's really important for investors to understand about that equal weighted that maybe can give you a bit of an uplift when those top names aren't performing versus the very concentrated names that now dominate that index? Yeah,
so I look at concentration risk as not as simple as just, at the top of this index is concentrated, right? I think you need to go a little bit further in that, if you look at a Nasdaq 100 strategy and an S&P 500 strategy, right? You may be using Nasdaq 100 for growth, you may be using S&P 500 for a core allocation, but you're going to see a lot of those same names in both. I mean, if you go back to the end of 2022, you had the likes of Microsoft and Amazon in the S&P 500 value index at reasonably high weightings, right? So I think that represents a level of concentration risk that maybe investors aren't fully aware of. So it's sort of looking across the entirety of the large cap portfolio outside of just one index, right? Like what do I hold? And ultimately, like what sort of overlap do I see? Because again, if you're introducing a value strategy that's designed to be a diversifier, but it's holding a lot of the same names, are you getting that same level of diversification that you want? So the equal weight side of things, that's where that comes in. I mean, naturally that is that diversifier. So I think picking up those smaller size names, if you do see a larger cap sell-off, think sort of early parts of 2022, we saw a lot of these names come under pressure. You can kind of mitigate some of that with just naturally overweighting other areas or segments of the market.
And when we look at the macro, maybe interest rates in the US are above 5%. That hasn't really weighed too much on the tech-heavy Nasdaq and related securities. So how are you thinking about that macro environment with interest rates higher? Many technology stocks are valued on the present value of their future cash flows, with many tech companies anticipated for growth and generating those cash flows further out into the future. So how do you think the macro plays into the Nasdaq and more generally technology?
Yeah. So I think when you look at the last two rate hiking cycles, the Nasdaq 100 has fared pretty well. You see a downturn kind of early on when the Fed embarks on a rate hiking cycle, and you look at 2022 as a perfect example. But then generally you see kind of a bit of a rebound. And when we look at Nasdaq 100 companies, I mean, these are not necessarily the same companies as 20 years ago, right? I think the balance sheet looks pretty healthy in most of these cases. A lot of the larger names are not necessarily running to the capital markets to finance operations. And then you start to look at kind of the debt perspective, right? We see a lot of debt coming due in 25, 26, 27, and these companies may have to refinance at higher rates, which will likely eat into earnings. You look at the Nasdaq 100 against the S&P 500, quite simply, it's less levered. So I think that has allowed these companies kind of to ride this interest rate wave a little bit higher and been able to kind of fare pretty well in these environments.
So the key takeaways are probably they're mature companies, they generate a lot of cash flow today, they have healthy balance sheets, lots of cash. Some of the bigger names are probably a bit more immune to those higher interest rates. Is that fair?
Yeah, I think that's definitely fair. And they've shown this ability to continue to grow fundamentals throughout these types of environments.
So are these relatively higher valuations a concern for investors?
Yeah, I think just knowing that, right, generally when you're looking at large cap growth, they're generally trading at higher valuations. You're paying for that future growth. If you go back for the past 15 years or so, the Nasdaq 100 has sort of traded in this PE band, right, the price to earnings band, looking from a trailing 12-month basis. So on the high end, it's been largely around 30, on the low end around 20. And going back to like 2006, for the most part, it's been in this band. Recently, like 2020, 2021, we saw it move up to close to 40, depending on the day that you look. They've touched 40, then came back down in 2022, and we've seen it sort of expand in 23 and 24. I think there's a lot of things that don't necessarily go into your traditional kind of PE ratio. I mean, one would be the amount of intangibles that are on these companies' balance sheet. They are a very large holder of IP. That doesn't necessarily get baked into your traditional kind of valuation metrics. And then they've been able to continue to grow, and the balance sheets do look pretty stable. So you may see market participants putting a bit of a premium on them. It's certainly something to be aware of, but it's more the fundamental growth picture that we try to focus on.
So for someone at the beginning of their investing journey, what are the key differences between the S&P 500 and the Nasdaq?
Sure. So in the Nasdaq 100, we went through the methodology. Pretty easy to understand. It's the 100 largest listed on the Nasdaq ex financials. What you're getting is a more concentrated portfolio, right? Only 100 names versus 500 for the S&P 500. And note that you're going to have a larger exposure to kind of these growthier names, right? Overweights in technology and some of those other growth-oriented sectors. S&P 500 is representative of the 500 largest stocks in the U.S. equity market. Inclusion into the index is determined by a committee. So once the S&P committee deems a company eligible, it will be added to the index. So there can be a little bit of a wait time for certain companies, but you are going to have more exposure in your traditional kind of value sectors of the market. Certainly more financials, things like real estate, like industrials, like healthcare. And your healthcare exposure is going to be more like large cap pharma or medical devices. Not so much the Nasdaq 100, which leans a little bit more like biotech and some medical device.
So how do you at Invesco analyze these fundamental growth stories?
So I think for us, it's been important to try to understand like what's driven fundamentals. So our team at Invesco, along with our partners at Nasdaq, we do a lot of work in evaluating things like R&D spend. We think these companies have been very adept at being nimble. They've been able to change over the past 2 decades. A lot of them look very different than they did a decade or two ago. And we think this starts with this long-term commitment to research and development. From there, we look at other metrics like patent filings, and we found that these Nasdaq 100 companies have filed a pretty considerable percentage of global patents that relate to certain disruptive technologies. So we think that's enabled them to kind of stay ahead of the curve when it comes to changing consumer trends or preferences. And then we look at the reported numbers of kind of the fundamentals. We look at revenue, we look at earnings, we look at dividends. And over the past 10 calendar years, through analysis on using a number of different providers, we see that the Nasdaq 100 has provided greater earnings growth, greater revenue growth, and greater dividend growth than that of, say, the S&P 500 or Russell 1000 growth.
Why is research and development such a key consideration for the companies in the index, and where do you see them investing?
I think R&D is sort of the first stop in quantifying innovation. Like when you look at research and development, it's a longer term idea because you're not throwing money at a project and expecting it to hit your bottom line next quarter or even next year. Right? So it sort of breeds this culture of trying to stay ahead of changing consumer trends. And this has been going on for a number of years, with the Nasdaq 100 spending more on R&D than some of their counterparts. With it, we look at the patent filings. Ultimately, like, what are you getting for that R&D, or where specifically are these companies investing their time and energy and resources? And what we found was, over 20% of all patents filed globally for themes like NLP, natural language processing, or wearable technology, or cloud computing come from Nasdaq 100 companies. In fact, natural language processing, over 40% of all patents filed globally from November of 2022 through November of 2023, our observation period, came from Nasdaq 100 companies. Looking at the patents gives a really interesting window in terms of not only where these companies are devoting their time and resources, but ultimately where they expect future fundamental growth to potentially come from. And we've seen a lot of AI adjacent themes that have shown up on sort of our patent categories over the past couple of years. So it's pretty clear that these companies have been investing in things like AI.
So what is the Nasdaq Next Generation Index?
So, with kind of the notoriety of the Nasdaq 100, we're receiving questions about, like, well, can you replicate this taking more of like a mid-cap view? Basically just going down in market cap. It's almost the next 100 below the Nasdaq 100. Very similar transparent methodology. You're looking at the 100 largest companies outside of the Nasdaq 100, also excluding financials. And it's important because it has the same rebalance and reconstitution schedule as the Nasdaq 100. So, what you'll see is companies graduate in any given year, around like 5 of them, from the next gen into the Nasdaq 100. So potentially getting exposure to some of these companies at an earlier stage of their growth cycle.
So what's the composition of this Next Gen Index, and what kind of themes does it focus on?
Yeah, so very similar to the Nasdaq 100, it's going to lean on the growth side of things, mainly technology, and you're getting consumer exposure. I would say the biggest difference is you're picking up more healthcare exposure in the Next Generation Index. Again, leaning a lot more towards some of these biotech names. From a thematic standpoint, they're also very active in terms of patent filings. You see a decent amount of overlap between certain AI themes like deep learning. From a thematic standpoint, things like the internet economy, certainly some healthcare themes. So, we see a lot of similarities between the two, and the Next Gen just kind of takes on more of a mid-cap look and feel.
How much of a tailwind is AI for the Nasdaq?
I think it's anybody's guess, right? If you can listen to people that are a lot smarter than me talk about how early on we are in this whole AI super cycle. Ultimately, we look at Nasdaq 100 companies, and there is some exposure to AI. We look at the patent filings. They have been filing patents across a number of different, call it AI adjacent technologies, natural language processing, speech recognition, deep learning, things of that nature. And then we look at sort of thematic overlap between the Nasdaq 100 and the specific AI and big data index. And around 60+% of index weight overlaps between the two. So while it's not strictly an AI index, you are getting some exposure to artificial intelligence, expressed through either the patent filings or, the overlap that we're seeing with the specific AI and big data index.
Ryan, it's been an absolute pleasure to sit down with you. If people want to hear more about Invesco ETFs, where can they go?
Well, on Invest Engine, you can search Invesco ETFs, and it's been a pleasure sitting down with you. Also, if there are any questions or people want to learn more, they can visit Invesco.com.